A very good evening to everyone. If you can see me, hear me, and see the slide, you can type in the chat box. Okay, very good, very good. Okay, while waiting for the rest, I just give a quick market upload. If some of you already invested in REITs. So REIT has been performed quite well for the past few days. Okay, let me maximize it. Dock and maximize. Just want to give an overview on what's going on in the REIT market now. So for the past week until today, REIT itself has already gone up by close to 8%. Okay, close to 8%. Just within 1 week, already up by 8%. The reason why it suddenly has such a good performance is because the US Treasury bill, the 10-year risk-free rate actually dropped by a lot. That's why immediately REIT has a strong rebound. So I just give you an overview first, so that you get all of you interested in investing in REIT like you have not done so. So this is the FTSE REIT chart. Okay, just want to give you an overview. At the present moment, actually, the FTSE REIT actually trading is quite low. You can see that from the historical point of view. Let me go to 5 years or 10 years. Historical point of view, actually at trading at the low end, very, very low. So in other words, basically the REIT sector is pretty underpriced now, and also the yield is quite high. Later I'll touch on you a little bit. So just give you some market update while waiting for the rest. Okay, now I come back to my presentation proper. Okay, I always have this problem because always block me this thing. Okay, so today webinar I will be focusing on introduction of a Singapore REIT. So this webinar itself is designed for the beginner. If you do not understand what is REIT, you know nothing about REIT, this seminar webinar is for you. If you have some background or seasoned REIT investor, probably this may be too basic for you, but you can treat it as a revision. So basically, in short, REIT is for the objective of investing in REIT is to generate a dividend. So it's suitable for the income-seeking investor. I will show a few examples in this webinar itself. Just take note that those are not a recommendation. It's quite dangerous if you do not understand and also know how to analyze a REIT and you just invest blindly. So there are a lot of opportunity in the REIT sector at the present moment, but there are also a lot of risks in the REIT sector at the present moment. About myself, I'm Kenny Law. I am currently working as a wealth advisory director and also REIT specialist from Singapore's largest independent financial advisory firm. At the same time, I am also the SGX and also IBF trainer. Every month, I will be on the Money FM 89.3 to give the Singapore REIT market outlook. So my next market outlook on Money FM will be on this Wednesday, November 8th. So if you want to know more about how the Singapore REIT market currently doing now and moving forward, what are the risks and opportunity, you can dial in and listen to the interview at about 10 a.m. I have two blogs. This is my blog, My Stock Investing, and also REIT Savvy. I post my REIT market outlook, some data. I'm showing some data regularly or on these two websites itself. So today content, I'll go through what is REIT and also introduce to Singapore REIT in Singapore Exchange. I will also share with all of you what are the differences between the REIT and physical property. And number 4 is the REIT as an income generating asset class and how to invest in Singapore REIT. Okay, if you have any question, you can type in your question through this link, www.pigeonhole.at. Right, key in this passcode 6 November 23rd. At the end of the session, I'll try to answer as many questions as possible. So I give you some time to key in this URL, or you can scan the QR code here. If you have any question, just post it there. Okay, I'll move on. What is REIT? REIT stands for Real Estate Investment Trust. Basically, the REIT will raise the capital from a unit holder to purchase the real estate together. They have to distribute more than 90% of rental income back to the shareholder. So in terms of the dividend sustainability, REIT is a better choice compared to other dividend stocks because other dividend stocks do not have this mandate. Other dividend stock, if they want to pay the dividend, it's very much depend on the dividend payout ratio, the management you declare. That can change. That can increase the dividend payout ratio. That can also reduce the dividend payout ratio. So in other dividend stock, there's no certainty. But for REIT, there is a certainty, 90%. In order for the REIT to enjoy the tax transparency treatment. Okay, in other words, there are some special tax treatment for the REIT investment itself. So REIT is the collective investment scheme. It's very similar to the unit trust. You pool the money together, invest into the certain underlying stocks in REIT. They are investing in the property. Then whatever return generated from the property, they will distribute back to the shareholder. And REIT is publicly traded over the exchange, professionally managed. And just do take note that REIT has a debt limit of 50% of total asset value. This is really something similar to our personal TDSR, total debt servicing ratio. So REIT itself, they also have certain ratio that cannot exceed. So just take note, 50% is the limit of the total asset value. So in short, REIT is the combination of shares and also the physical real estate. So most of the us in Singapore, we always like to invest in the physical asset. So not most of the time we just invest in one building, two building, or not building, one house, two houses, or a shop lot and those things. But for REIT, you don't invest in the whole unit itself. Basically, you're just holding a portion of it. Basically, is using the shares. The business model is very straightforward. So for REIT, there are two forms of the money come from. One is from the investor that pool the money, provide the investor, you provide the funding to the REIT itself. The other portion basically coming from the bank or creditor. They loan the money to the REIT. And after the REIT got the money, they will go out to purchase the real estate property. Depends on which sector they are in under the investment mandate. They can purchase a commercial office, they can purchase a retail mall, they can purchase logistic, student accommodation, hospital, healthcare, nursing home, so on and so forth. It depends on what are the mandate they are able to invest in. So after invested in the property itself, and the property will generate the rental. Every month they'll collect a rental. Whatever rental collect back to the REIT itself after paying off all the working capital expenses and also interest payment, the 90% of taxable income they have to pay back to the investor as a dividend payout. Okay, so it's very straightforward. When you come to reinvesting, basically it's a landlord business. You buy a property, you rent it out, you pay off all the expenses, whatever return you keep, you just pay it back to your shareholder. So if you have a following objective in investment, right? For example, you are expecting your investment can provide you the regular dividend payout, or you are expecting the very stable passive income, either half yearly or quarterly, and your holding horizon is between medium to long term. Basically, it's not one month, 2 months. You are having the holding period 3 months, 5 months. 3 years, 5 years, 10 years, 20 years. You are building for a retirement fund. REIT is suitable. Because while you're holding the long term, besides getting a dividend, you also will enjoy the potential capital appreciation over the long term due to the inflation. You just imagine if you're holding the property, you are investing a property in a good location. Every year or every 2 or 3 years, your rental definitely will increase because of inflation. And over the long-term period, your property value also increase because of inflation, right? Just look at the Singapore property index, value index itself, you know that actually they are going up year by year. So we also have this kind of characteristic. Introduction to Singapore REIT. REIT in Singapore is not new. So they already have about 21 years of history. The first REIT listed in Singapore was the Capital Mall Trust, listed in 2002. So Singapore REIT is already 21 years old, have gone through a few financial crises, okay, definitely have gone through the global financial crisis, and during the dot-com phase, and also the COVID crisis. So some of the REIT still doing pretty well, still pretty resilient, can survive until now. So REIT is really suitable for long term. At the present moment, under the Singapore Exchange, there are total 42 property trusts and REIT listed here, and the total market capitalization is close to 100 billion. Average dividend yield is about 7.5%. And if you look at the price to book itself, price to book indicate the valuation of the REIT. Anything below 1, the price to book below 1 indicate is the undervalue. So 0.73 times of the price to book means that currently the Singapore REIT sector as a whole is trading 27% discount to the fair value. And beside that, if you Singapore REIT also provide you a very good diversification. Although the REIT are listed in Singapore, but majority of them have the overseas property exposure. So if you look at this pie chart here, there are only 3 REIT in Singapore have 100% property in Singapore. Only 3 of them. And 20 of them, they have a property in Singapore and also overseas. And 17 of them, they have 100% property overseas. So in other words, investing in Singapore REIT also allow the property investor to diversify to the overseas property market. And beside that, you also have a diversification into the different sector. For example, on the pie chart on the right, you can see that 20% of the Singapore REIT actually from the industrial sector, 13% hospitality sector, 23% diversified sector. Diversified means that they have a property the combination of different asset class there. For example, some of them have a retail, mall, and office combined together. Some of them have an office with the industrial combined together. So they are classified under the diversified REIT. And 20% retail REIT. And if you pay attention, you probably have visited some of the mall before. For example, Plaza Singapura, Junction 8, Causeway Point, they are all under the REIT. 15% from the office rate, and we also have 5% of the data center and 5% from the healthcare sector. Healthcare mainly investing in those property used by the hospital. For example, Mount Elizabeth, and also some of the hospital in Singapore. Probably you already know that, Pro Hospital. And beside that, you also have a diversification into different regions. So some of the REIT have exposure in South Korea, Hong Kong, Malaysia, India, China, Japan, so on and so forth. At the present moment, the average of the Singapore rate give you about 7.5%, and compared to the SDI index, give you the dividend yield of 5.2% versus the 10 years risk-free Singapore government bond of 3.2%, and also the inflation. So as an investor, one thing to take note, no matter what we do with the money or invest in the money, or whether you put in a CPF, you invest in the T-bill, invest in the SSB, or invest in REIT, invest in dividend stock, invest in any other thing, in order to preserve your purchasing power, you need to make sure your investment return at least to beat the inflation. Okay, so at the present moment, 3.8%. And as an investor, your job is to look for asset class that can beat the Singapore inflation. And S-REIT offer one of the highest dividend yield and low volatility. On the y-axis is the dividend yield. Of course, the dividend yield, the higher, the better. But at the same time, you also do not want the share price volatility be too high, because as a dividend investor, we want our capital pretty stable, not like one day go up by 10%, the other day drop by 20%. We do not want that kind of volatility. So the volatility is measured by this x-axis. The higher the number, the percentage indicate the higher volatility. So in this chart itself, we can see that S-REIT actually has one of the highest dividend compared to other exchange, other REIT index, and at the same time have a lower volatility. And the other important thing to take note that we all when there's a market correction, or when there's a bear market, we do not want the REIT also drop together with the other stock market too much. So this is a correlation analysis. Okay, so you can see from here that the S-REIT index, they have less correlation compared to US REIT, only 0.62, US equity 0.48, US bond 0.64, and global REIT 0.74. Okay, it's a bit technical for you to read this chart. Okay, so in short, whenever you invest in other asset class, whenever you are building a diversified portfolio, just make sure that they are not highly correlated to each other. So anything closer than one means that highly correlated. Anything lesser than one, the further away, close to zero, is less correlated. If you see any data minus correlation, which means that if the REIT index go up by 1 point, the other asset class actually go down by 1 point. So that is called negative correlation. So you can use this correlation chart to build your portfolio. I move on to share about the differences between the REIT and also physical property. So when it comes to the property investment, one thing to take note is a transaction value. So if you are investing in the physical property in Singapore, for example, $500,000 probably you can get a industrial B1 factory, small factory, and also a warehouse or shop lot. Right, the investment amount is pretty huge. So if you make some mistake, or you are not able to refinance the debt, or you have some cash flow issue, you have to force sell your property in the open market, and at the time you don't have any buyer, you probably suffer a lot of losses. So investment mistake is quite costly when you owning physical property which has very high transaction value. But for the REIT itself, the investment value is pretty low because in Singapore exchange, the minimum lot to own a share is basically 100 share. So if there's any mistake made, basically they are still quite affordable. Okay, and when it comes to tax and cost, there are a lot of taxes when you're owning the physical property. For example, the residential property here, basically you'll be subjected to buyer stamp duty, additional buyer stamp duty, seller stamp duty, property tax, rental income tax. Those are recurring. And beside that, you also need to pay for all the related transaction costs. For example, you have to pay for the agent, you have to pay for the lawyer, your contractor for renovation. While owning the property, you also need to pay for MCST costs every quarter, maintenance costs. And beside that, you also need to pay for your home insurance and also mortgage insurance. Those are recurring. So because of there's so much cost involved upfront, and you definitely need a proper estate planning, because if you don't do the proper estate planning for your property itself, your beneficiary probably they'll be subjected some of the taxes or also incur unnecessary costs. The beauty of Singapore REIT investing is basically there are no capital gain tax, no dividend tax, and also no estate duty. And the trading fee is pretty low. There are many broker recently coming up in Singapore. So some of the trading fee can be as low as $4 per transaction or 0.08% of contract value. It's pretty competitive now. In terms of the management, if you are a landlord, you have to deal with your lease management, deal with the tenant, and also deal with the property, fixing all the property issue with your tenant. And also you need to engage a lawyer when you buy and sell your property. Of course, you also need to regularly need to talk to the banker to do a refinancing, especially during this period. All the refinance costs are gone up a lot. You need to actively negotiate for the lower interest rate. But for REIT itself, you do not really need to worry about all these things, because at the end of the day, you are just an investor. The rest of the activity, the operation issue will be deal with the REIT manager, and REIT manager will deal with the property manager and also a trustee. So basically, it's quite hassle-free when it comes to REIT investing. In terms of yield, investing in physical property, residential property in Singapore, the yield is between 2 to 4%, commercial 4 to 6%. And one thing just to take note that if you do not have any tenant to fill the gap, immediately you do not have an income. You will be losing your income, but at the same time, you also need to pay for all the mortgage loan. So there is a risk that if you are not able to tenant your unit out for 6 months, and you need to have a free cash flow or some on the cash standby to really must for you to pay for all this kind of mortgage. So it's pretty stressful when you holding the physical property itself. But for REIT, as long as you invest before the X dividend date, there's an XD date in the stockbroking platform. As long as you invest before that, you will be subjected to receive a dividend. So the dividend at the present moment, in general, 4 to 10%. This one in general, all right. Of course, during the current market conditions, some of the REIT has a dividend more than 10%, some of them even 20%. And a payout every quarter or semi-annual. In terms of portfolio diversification, mainly the portfolio, if we invest by our own self, mainly will be in Singapore. And because if you move to the overseas, investing in overseas property, they are just too much hassle to manage the overseas property. But for REIT, as long as you have the trading account with any brokerage, when with a click of button, you are able to access to the globally diversified portfolio. Okay, and typically there are 5 Singapore traditional sector. Okay, but of course now recently there are some of the new sector coming out. I will touch on that a little bit. So these are the traditional one. You have a commercial office, which comprises on the commercial office building. You have the industrial and logistic. Inside industrial and logistic, you have an e-commerce warehouse, you have factory, and you also have ports. retail mall, you have the suburban retail mall. You also have those luxury retail mall like in at along the Orchard Road. Healthcare sector, basically they have a hospital in their portfolio and also nursing home in the portfolio. Hospitality, you have hotel, service resident, and also student accommodation. And recently, there are two new asset class coming out. One of them is a student accommodation. At the present moment, student accommodation is classified under the hospitality sector, and a data center in general classified under the industrial sector. But it may be moving forward, if more and more data center to be listed in Singapore Exchange, maybe they will classify another new growth sector. Some example, probably you already know. For example, or you have visited before, Vivo City. Vivo City is under Mapletree Pan Asia Commercial Trust. If you're staying in the west, you probably pass by this A-Lock Commodity Hub. Okay, A-Lock Commodity Hub is under ESR Logos REIT. Suntec City under Suntec REIT. Mount E under Parkway Life REIT. And if you know the Hyatt brand, you probably know the Hyatt brand. So Hyatt Hyatt Place brand in US is under the AIA US Hospitality Trust. This is a hotel. So local diversification. If you have enough capital, actually the capital is not a lot. For example, 50,000, you just buy all these street in Singapore. Okay, you will have a diversified portfolio of about 453 portfolio in Singapore around across a whole region, the whole island. And if you find that you love the Orchard Road very much, if you walk along the Orchard Road, there are total 9 S Street along the Orchard Road. You have the Parkway Life, Far East Hospitality, Star Hill Global, OUE Commercial REIT, Land Lease Global, Escort. Yeah, that's it. These are the few nine REIT listed in Singapore along the Orchard Road area. You have hospital, you have service resident, you have the retail mall. Okay, there are plenty for you to choose. If you find that Singapore is just too small, you want to have a globally diversified portfolio, there are many. Okay, so we have Manulife, Prime US REIT, United Hemisphere, they are all in US. Okay, basically, you can invest in those REIT have exposure in US in USD. You have a lot of USD, you have nothing to do, right? You can consider to allocate some of the USD into this US REIT, and in return, you'll be receiving a dividend in USD. We also have a REIT listed here, have an exposure to UK. For example, Elite Commercial REIT, they are in UK. You have Cromwell, basically in the whole Europe itself. You have IREIT Global Land Lease in Italy. There are some portfolio in Italy. In China, you have EC World, you have BHG, you have Sesio, and Australia, so on and so forth. So plenty of for you to choose. So in short, having a REIT portfolio is equals to having a global diversified portfolio. Basically, you can decide whether you want to focus in Singapore or you want to focus on global. Okay, so buying all these for this REIT, you can show off, maybe show off to your family, show a friend. Actually, you have 1,000 property globally. A REIT as the income generating asset class. I'll share with you what are the yield comparison for this asset class. So this is the Singapore REIT in average. That means that I'm using the 38 Singapore REIT, pure Singapore REIT, and do a simple average on their dividend yield. Okay, this is October data, right? So if you average out together, they give you 10.44. Of course, there are some outlier there. Some of the REIT have a 30% dividend, some of them a 20% dividend. Okay, and this definitely beat the Singapore inflation of 4% compared to other instrument like bank saving at 0.05%, 12 months fixed D, 1 year T-bill, 5 year, 10-year T-bill, Singapore saving bond. So they are between 2 to 4% range. So these are the relative safer or less free risk-free that kind of income investment. So there is a risk premium here. So the wider the risk premium indicate the more attractive of a Singapore at the present moment. Okay, because for example, if you're looking at 10 years government bond, as long as Singapore government don't go bankrupt, this is considered the risk-free rate. So there is a 6% point 600 basis point risk-free risk premium for investor to consider. So this is how the investor or the big institution, when they come to allocate the resources to decide whether want to invest in Singapore or invest in a 10-year bond, this is part of their decision-making criteria. If you compare to other dividend stocks, these are the list of the dividend stock in Singapore compared to the 1-year T-bill. 1-year T-bill for October itself about 3.83, and these are the dividend for different dividend stock in Singapore: DBS, UOB, OCBC between 4 to 5% range. Singtel, SIA, Capital Venture, SGX, Samcorp, Industrial, ST Engineering. So this just give you a feel on what is the dividend payout under the current situation listed on the Singapore Exchange. And if you compare to the different sector for the Singapore REIT, office sector has the highest dividend now. Okay, because at the present moment, the US commercial office has beaten the share price beaten down a lot because of the work from home phenomenon, still pretty slow. They are not like Singapore or in this region. Most of the employee already back to office or at least have a hybrid working arrangement. But in US, the occupancy rate for the commercial office is still pretty low. So because of that reason, on top of the high interest rate environment, the property value of the US commercial rate dropped a lot. That actually immediately give a very good high yield on the office REIT because of the share price being sell down a lot. So followed by the retail sector, 6.5%, diversified REIT 6.4%. So you can see that if you have a long-term view of when you come to if you want to build a retirement portfolio and you want to have a passive income at the present moment, because of all this high yield represent a good opportunity to investor to buy the REIT at a huge discount, at the same time lock in a high yield. And one thing to take note that just now I already mentioned on the inflation, this one is just to give you some of the visualization, what will happen to your money if you do nothing with your money. For example, if you park your money, still park in the bank, don't know what to do, and you don't invest, and over the long term itself, your money you'll be keep shrinking because of the inflation, right? So if you are able to find some instrument, for example, REIT in this case, 6 point something percent to beat the inflation of 5%, over the long term, your portfolio value, your wealth will grow over the long term. So bottom line, the key message here is look for something to beat inflation, then your money will grow. If you invest something that not able to beat the inflation, your money will shrink over the long term. Okay, until now, if you have any question, okay, this is another opportunity for you to key in the question here. Just take note to key in this www.pigeonhole.at, key in this passcode, or you can scan the QR code to ask your question there. All right, I'll move on. So how to invest in Singapore REIT? So this is the dividend portfolio for retirement. Okay, I go through this retirement portfolio very briefly because I have another retirement webinar. You can attend the other retirement webinar. So at the end of the day, if you're planning for retirement, you need to have a multiple source of income. So the first layer of income basically is come from CPF Life. Okay, after you build a CPF Life, the second layer, you can focus on annuity endowment so that it can give you some of the fixed income when you retire. But the disadvantage for level 1 and level 2, basically, they are not inflation hedge. If the inflation go getting higher and higher, you definitely need the level 3 of the dividend portfolio or REIT so that over the long term, you are able to hedge your inflation. Because the REIT portfolio and also the dividend portfolio over the long term, the dividend should be able to increase uh, year over year due to inflation to offset the inflation risk. Okay, so it's important for you to build level one, level two, and level three for your passive income for dividend. If you have already built out your level one, two, three, then level four is slightly risky. You can use the alternative investment for a much higher growth or much higher income. Okay, so REIT basically is in the level three. Okay, so how to build your REIT portfolio? There are basically 5 steps. First of all, you have to define your objective. If your objective is to aim for capital appreciation, you want to double your money within 1 year, 2 years, forget about it. REIT is not suitable to you. REIT basically is for income. So if your objective is you want to buy something, you want to invest something over the long term, can give you some capital appreciation, and at the same time can give you consistent dividend to as your alternate source of income, then REIT is suitable. So you have to be very clear what is your objective first. Okay, so the objective is income. After you define your objective, the next thing here is you shortlist what are the REIT you want to invest. Okay, shortlisting is important. The shortlisting basically you are identifying some of the good REIT that you want to keep and some of the or under the watch list and some of the bad REIT that you want to remove from your shortlist. All right. Then after that, you conduct a detailed evaluation. After you conduct all the evaluation, basically you have a portfolio of watch list. Just put under watch. That means that you are not going to buy immediately. The reason being is because you still have to check whether the REIT at the present moment is trading at the right price and also the right time. If not at the right price and the right time, you should not trigger your buy button. Okay, then the step 5 is diversify your portfolio. So there are a lot of financial ratio that you definitely need to know before you trigger your buy button. Okay, at the present moment, you can see that actually the yield itself is pretty crazy. Manulife rate, these are the first thing note, these are TTM, the trailing 12 months, 89% yield. Prime US rate, 56%. Capital Pacific Oak, 28%. EC World, 16%. United Hampshire, 13%. You can see that the yield is pretty crazy because there are a lot of fear in the REIT sector now. And the gearing, some of them, because of property value drop a lot, the gearing already breached the 50% mark. And in the first few slides, I mentioned about the limit is 50%, but they are breached at 50%. That's a reason that some are pretty high risk. And they are trading at the 5-year low. You can see that most of the REIT here, quite a number of them are trading at 5-year low, which means that they are pretty cheap now. And you also need to understand what is the occupancy rate, will the lease expiry, interest cost, what's the interest coverage ratio, property yield, and the debt maturity profile. All these things before you invest in REIT, I would strongly suggest and recommend you must understand how to interpret all this data, because from this data, you are able to filter the good REIT and also the bad REIT. Okay, once you are able to filter and build a watch list from different sector, it is quite easy for you to build a portfolio of 6.35% in this case. And under the current market condition, it's not difficult at all because the share price now is pretty low. So it's more important thing is how to identify the top 3 in each sector. Okay, top 3 in retail, top 3 in office, top 3 in industrial, hospitality, and also healthcare. Then the next thing is you just need to wait for the valuation is right and also the price is right. And if you know how to use a technical analysis to analyze, then you will be buying at a very good entry point. So I have a coming up course this month over the 2 Saturday, 18th or 20 and 25th, right? 2-day online courses covering all these 14 hours of training. Okay, basically I'll go through to help you how to align your investment objective to the REIT, and I'll explain how the REIT work, how to choose the REIT, and how to read the external news, external event, corporate action. And I also teach you how to use a technical analysis to time your entry. And at the same time, theory is theory. After I cover a theory, I also invite two special guests, the CEO from Sesio REIT and also CEO from OE Commercial REIT, to share with all the students what is the current climate in China, because Sesio REIT is the property in China, OE commercially the property in Singapore. Some of them you know pretty well, because you also maybe visit some of the REIT itself, some of the places itself. Okay, so this is an overview of the what is the current price to book for the REIT now. Okay, so the Singapore REIT can be represented by the FTSE REIT index. Okay, and March 2020 actually is the market crash due to COVID. You can see that actually the REIT dropped by 40% during the March 2020 crash. So before the crash, the price to book, the valuation is trading at 1.1. During the crash, the valuation drop was 0.8. So at the present moment, because of the rising interest rate environment, the share price keep dropping. The valuation is even lower than during the COVID low. Okay, price to book is 0.73. So in short, based on this chart itself, Singapore REIT is hugely trading at the discount at the present moment. And if you look at the 10 years chart, S-REIT index is trading over the 10 years low. Okay, so in another word, it's pretty cheap. It's pretty cheap. It's 10 years low, right? So it depends on how you look at it, whether you are looking at it as an opportunity or you're looking at a risk. Okay, let's say that everything will go back to normal. The interest rate eventually will come down. The interest rate cannot be staying high so long forever. And US and China, eventually they'll become friends again. Okay, because based on history, they always fight with each other, sometimes become enemies, sometimes become friends. Eventually, if everything go back to normal itself, you just look at it, what is the upside potential? Now we are at absolutely low. If we go back to the median level, around this level, from 652 point until maybe 800 point, they are close to 20 to 30% upside potential just on the price only. 20 to 30 upside potential on the price. At the same time, the dividend yield 6.0%. And interest rate eventually will come down. This is the interest rate cycle. You can see that whatever goes up must come down eventually. I circle all these red boxes is to indicate when the interest rate start to come down this period. Okay, just take note, this period from 2009 to 2017. This one is 2019 to 2021. Okay, all these red boxes. Okay, because this is important when I show you the next chart. And also the other thing to take note that this interest rate cycle has happened before. During the 2006, 2007, you can see that actually the interest rate going very fast, very steep. And when they hit close to 5.5%, which is at the current level now, they are moved sideways for a while. At the present moment, based on a dot plot and also based on US futures, it looks like it's going to move sideways for a while. Then after that, the interest rate will start to reduce sharply. Okay, so if the history repeat by itself, we may see the repeat of a performance of REIT sector during this period. Okay, so this is a sector performance chart under the different interest rate cycle. So you can see 3 boxes still here. Okay, I just want to show you that these 3 boxes represent when the interest rate start to fall. And you look at the REIT performance when interest rate start to fall in 2003. REIT have a total return of 38%. 2004, 30%. 2005, 8%. 2006, 34%. You can see under the low interest rate environment or interest rate start to drop, REIT you tends to perform quite well. When interest rates start to go up, you can see that in 2007 and 2008, REIT is one of is the worst performer, minus 18%, and subsequent year minus 37%. Okay, and 2009 to 2017, basically the interest rate come down again under the low interest rate environment. REIT 27%, 27%, 7, 20, 3, 27, 2, 9, 9. 1, 2, 3, 4, 5, 6, 7, 8 consecutively 2, 4, 6, 8, 9 consecutively 9 years of positive return. Now we are seeing the same pattern again. 21.9, the interest rate start to drop, start to perform. Now 2022 rate minus 25. And until now, 2023, the REIT sector is still negative. So consecutively 2 years of a negative return. This is something very similar to 2008, 2007 and 08. If the history repeat by itself, maybe the same pattern will happen again. So that represent risk or represent opportunity is for you to answer. Okay, it is quite clear cut already based on pattern. So if you are able to identify those good REIT, and those REIT always show a very consistent growth in dividend over the long term. These are dividend payout every quarter. Okay, you can see that at the present moment, one of the diversified REIT in Singapore giving a dividend of 5.54%, industrial 5 or something percent. Now the share price drop even higher. So it's not difficult for you to look for those REIT with very consistent increase in the dividend over the long term, and at the same time trading at a huge discount. So it's for the investor, go and identify them. And as long as you buy the REIT at cheap, lock in a high yield over the long term, you do not really need to worry too much. So always take note that before you invest in REIT, always need to make sure you do a proper education. So this is one of the example that I give a recommendation to my client. I make a self-recommendation on the EC World REIT. All right. EC World basically at a point of time trading at 72.5 cents. Okay, but there are a lot of financial ratio. You can see that I already indicated here WADM, a debt maturity profile, and also a finance cost, and they are not able to really refinance. A lot of risk already happened here. So I issued a sell call to my client, basically to sell at the high. Okay, this one was issued out in January 2022. Okay, and what's going to happen? What happened after that? Okay, so for those investors who took my advice that sell away the REIT, basically they lock in the profit here. Then since then the share price has already plunged 61%. Okay, losses. All these things can be anticipated and it can be predicted. And until now, the trading is still suspended, and very high chance they are not able to get back their money if those investors that did not sell or run when all these things happen. So it's important avoid paying a hefty school fee to the Mr. Market if you do not know what you are doing. And if you can do it well, you also can, if you can do it well, getting a regular dividend payout is not an issue. Okay, this is my own personal statement. My own personal passive income portfolio. I have different portfolios serve different purposes. Okay, so based on this statement itself, the 1 year statement, April 2022 to April 2023, I have close to 30,000 of annual dividend for my passive income portfolio. So it's not, this cannot be done overnight. You need to spend 10 years to really build out the dividend portfolio. I spent about 10 years to build out my dividend portfolio. So if you are planning for retirement in 10 years down the road, 15 years down the road, it's better for you to start building a portfolio. So if you want to know more information, okay, this is the QR code. All right. Okay, I leave it here for a while. Just take note that there are some criteria to sign up a course to enjoy the subsidy. So all in this link. Okay, I'll not go through in detail. You just can do a QR code scan and check out what is in those courses and how you can enjoy those subsidy. Okay, if you do not have time or you find that it's just too much work and too tedious to do all the homework and also monitor the market. You need help. But at the same time, you also do not want to waste the market opportunity now, especially now the Singapore rate has a strong rebound. Moving forward, when interest start to come down, you need some help. You want to kickstart a portfolio immediately to enjoy the return. Okay, you can book an appointment with me. All right, if you are interested to go to the REIT advisory services, so I can straight away help you to build a REIT portfolio, and you do not really need to worry about all those homework. Basically, I just share with my own watch list with you. I help you to execute it. I help you to manage it. I help you to deal with all the corporate action. Basically, it's an outsource model. Okay, you just sit there and just collect dividend. All right. So that's all for my tonight sharing. Now I will move on to look at all the question you have. Okay, nobody can predict the bottom, but what I can tell you that there are few points, mainly three key points. I always use these three guidelines to guide me to anticipate when it's a market bottom. The first one is a valuation, fundamental analysis. Based on all the ratio, all the valuation, all the price to book, uh, fundamental reason, more or less they already bottom because it's already even get even lower than the COVID March 2020 crash low. And also based on the valuation itself, based on the price to book, the range for my past 10-year tracking itself, they are trading at the lower end of price to book. So that's a fundamental analysis. Based on technical analysis, I have shown you the chart. They are trading at 10 years low. Okay, and even lower and getting close to the March 2020 close. Okay, technical analysis already there is a very strong support there. That's the reason why the REIT has a strong rebound. The third reason in interest rate. The REIT is very sensitive to interest rate. So whenever the interest rate is high, the REIT tends to underperform. And I show you some of the data also just now. When interest rates start to come down, then for the next few subsequent years, just now I show you if the history really repeat by itself, and the next 9 years will be bullish. Okay, based on the past pattern. Okay, not necessarily it may be enough. Next 9 years will be bullish, but as long as interest rate come down and also stay low, that will be the appropriate turnaround. So based on these three factors, FAT and also the macro environment or interest rate environment, it looks like it's bottoming. Yes, REIT can give the capital gain. All right. If you are buying the REIT at a discount, huge discount, it can give you immediate capital gain. So for example, today and for the past few days, the US commercial rate easily give you 20% capital gain in just a few days, right? The key thing here is you need to identify those REIT with selling at a huge discount, because every day, as long as there's a trading day, there's a price movement, you can get a capital gain. But if you're holding for long term, if you're holding a blue chip over the long term, the blue chip, you also can give you a capital gain. You just look at it. When you are investing in REIT, you are investing in physical property. Over the long term, the rental you go up, your property value will go up. Okay. So because of inflation. Okay. So as long as you understand you are investing in property over the long term, they'll go up. DCA makes sense on REIT, not 100% work for REIT, the DCA. The reason being is because REIT is not trading as like the unit trust. So every time you go in, minimum must be 100 share. And if you have maybe $100 per month, you want to invest consistently, no way you can invest in Singapore REIT, no way. Because the commission you kill you, and also you end up a lot. So it in short, the short answer, no. Unless you are investing in REIT unit trust. then the DCA, it makes sense. Okay, but you're investing through individual REIT, no, DCA does not work. Okay, which three REIT has 100% Singapore exposure? Far East, Sabana, and Fraser, Central Point Trust. What are the risks to invest in S-REIT? So there are a lot of risks if you know. Okay, basically, okay, when it comes to property investment, you just don't talk about REITs. Okay, is REIT is similar to property investment. When it comes to property investment, what are the risks? First thing, you cannot find a tenant. All right. But if you're investing in individual property, if you cannot get a tenant, basically you have a zero income. But for REIT, because your portfolio is very diversified, one portfolio not generating income, the other portfolio still can generate income. That can mitigate the risk. Second thing is you need to borrow the money to invest in property, right? Nobody 100% cash now to buy property. So similar to REIT, they need to borrow a property from a creditor. They need to borrow the money from investor, pool fund to invest, right? So if they are not able to pay off their loan, pay off their debt, they have to then they'll declare default. And the other thing is, when you invest in the REIT itself, normally the refinancing period is pretty short, maybe 5 years, maybe 10 years, maybe 3 years. When they need to do the refinance, when the interest rate is high, then you have an interest rate risk. Okay, so just think of whatever thing you can think of in a property that's applied to S-REIT. They are just I just listed a few. To start investing in REIT, must we start with broker like SGS or is okay to online? You can use any broker as long as they have the REIT listed on their platform. So you can do that. What is appropriate model to value the share price of the REIT? Okay, you can use a price to book as a more straightforward. The reason being is because when you come to property investing, you always compare the current price versus a fair value. Property, there is always a property valuation. So example, if your property value at $1 million, and if someone is willing to buy from you 1.1 million, okay, the price book is 1.1. Right? So if nobody want to buy from you the 1 million, right? They only offer 900,000, then you agree to 900,000, then the price to book is 0.9. So that price to book is a much more direct valuation of the REIT itself. But on another hand, just take note that whatever information outlined there, they are all lagging data. They does not represent the forward data. So so just take note that whatever price to book, whatever dividend used are all lagging. Okay, of course, you have some other model, for example, discounted cash flow or DDM, discounted dividend model. So those are model, but more widely used will be the price to book. What is the percentage of income and growth stock that I should hold in your investment portfolio? It depends on your risk profile and also objective. It's not the straightforward answer because it very much depends on the personal situation. Uh, in short, I just do in short, very simple one. Normally, when you are younger, you just come out to work, your risk profile will be higher, then go for maximum growth as much as possible. Okay. But when you are reaching the retirement age, your risk tolerance has to drop because you do not have time to recover all the losses. Just take note that whenever you invest in the stock market, you must be able to wait until the recovery if there is a bear market or market crash. So during the retirement age itself, you don't have time to wait because you need the income immediately. And at the same time, maybe you are no longer working, you cannot rely on your work to generate income. That is better for you to go defensive. When you go defensive, you just need to make sure all your capital to be protected. So you don't subject to that kind of volatility because you can't afford to lose all the capital you have. You need to make full use of capital to generate the income for you, okay, as a supplement. So I can't answer your question until I know your personal situation. Okay, but you can book a appointment with me to at least go through this so that I can understand your situation better. I can give you a more maybe more precise advice. What is the regulation of a property revaluation? Okay, every year the REIT has to get a property, do the property valuation. So every year, it's not mandatory they do every half a year, but every year when they have a closing of financial year, they have to revalue the property. They have to get, I think, two or three valuer to do all the property valuation, right? Then they have to recalculate all the all the NAV, net asset value. Although interest rate have likely peaked currently, however, this higher the longer rate have yet to fully hit the REITs yet. Hence, REIT earning will continue to drop. Yes, the REIT earnings is expected to continue to drop for personal view for next 1 or 2 quarter. Okay. Then after that, probably you'll be stabilized a bit. On another hand, you also need to understand that uh interest rate is only one effect, one impact. On the other hand, we also need to understand why the interest rate keep going up. The reason is because of inflation. So the inflation eventually you go to your rental. Your rental you continue to go higher and higher. So for those REIT with a shorter lease expiry profile, eventually when they renew their rental has to go up. So if the rental go up more than the interest rate hike, okay, who knows, the DBO may come back again. So it's very much depends on the balancing up between the lease expiry profile and also debt maturity profile. Okay, so now it's 8:30 sharp. Okay, any last question? Okay, if no more last question, all right, I show the screen for last time. If you need to reach me, I can be contacted through kennylaw@fapl.sg. Right? If you need any help to straight away to help you to kickstart your REIT portfolio, you can book an appointment with me. I'll see how I can help you. Right? If you want to learn how to invest in REIT, want to know the ABCDE everything, okay, and this is a course coming up course. All right. So that's all for tonight. Okay. Thank you everyone for attending. I hope this is useful to all of you. All right. Thank you. Good night. Bye bye.